So for everybody's benefit, just what the recording is, we're gonna talk about how to think about your business taxes first, and how to think about your personal, what it means for you individually as a founder next. And the 1.0 regroup from just the last conversation is your attorney ultimately works for the company, not for you, but you need to have somebody on your side in this process to make sure the things that work out are actually working out in your best benefit as well as the company's best benefit. So at some point you need to think about both. I know from a fiduciary duty standpoint, we think about the company first, totally smart, what all of us as board members do. But at some point you got to think about, especially with things like liquidation preference and this waterfall stack, you need to know about what's in it for you as well. So Matt Medlin, I'm going to hand it over to you.
Great. Thanks a lot, Dave. I appreciate it. And thanks everybody for coming. 9 o'clock sometimes feels awfully early, but here we all are. I can share my screen if whoever can give me access. What I'll put in front of you is just a 2-page checklist, not a 30-page PowerPoint. I'm going to hit on really, as Dave said, from the business side now, and then the Morgan Stanley gang will talk about you personally. So again, so let me see now to share. Now I have to pick the right one, which is always particularly horrifying. Okay, let me know if something has come up that looks like I'm preparing for exit accounting as opposed to YouTube.
Yep.
Okay, good. That was always scary. The one thing, and hang on, now I need to get my other deal correct here. So one thing I want to emphasize, this was geared, and I'll scroll down to the bottom quickly. I won't scroll on a lot, but this bottom part is super important. You know, this is meant to be helpful, but is not reliable. You've got to build something for your own company with your own advisor team. So, you know, if you know, don't run around and check this through and then wonder why your exit failed, because that's Dave's fault if that happens. But again, it's meant to be helpful based on our experience, et cetera. I always lead off actually not talking about taxes, but talking about document management, because we do see a lot of exits fall apart because founders and their team can't find the paper, can't find the documents. So step one in life for a startup, in my view, from a backroom perspective, I mean, this ignores all those subtleties around building your team, building the product, finding customers. We don't worry ourselves with those mundanities. We focus on, you know, the importance of document management and taxes in our world. So with, you know, joking aside though, pick a tool. I don't care what it is, Box, Dropbox, Google, any infinite number of others. Cloud-based is always better in my view. And then work with your attorney on employee setup matters. And I won't get into that anymore, but all the releases and IP stuff, I only put that in to say the next thing, which is in this tool, store all of those signed agreements, fully signed agreements. Any other signed agreements you get, leases, marketing agreements, anything else, just have a place, stick it in there. Don't try to organize it yet. Just put it in there, and later you can organize it, and you'll inherently organize it just because you need to find stuff and you'll build sub files, but just get it signed and put it in there. So perfectly okay based on your attorney's advice, use DocuSign or any of the other signing tools. That's all good. Just get it in there, get it signed. All your financing documents, warrants, stock options, all that stuff, just throw it in there so you have it. Also consider, as you develop a little bit, a system to manage your cap table. As Dave said, that waterfall analysis is super important to you as individuals when you get into this. And so a good cap table management tool, Morgan Stanley has one, there are others out there too. And it will keep track of not only who owns what, but also give you a place to store key documents as well. You only need to store them once. If you decide to pick a tool like that, don't store them in one place and the other. Just keep them all there, but be kind of picky about making sure it's in there. And your attorney will have some advice on this too. and have usually kind of access to it as well, so they can help you kind of keep that organized. So again, I've seen deals collapse because people can't find, they've got a great plan, and the VCs have literally said, it seems like a great idea, we like the team, but they always struggle to put their hands on stuff, so we're just going to go to the next alternative in funding. And then certainly during an exit, when you're under the gun and can't get stuff pulled together, that's another key thing. So with that, any questions from folks? I'll just move on quickly to more of the tax matters.
Matt, one quick note there just for everybody. I think you can start this in a Google Drive or a Dropbox. At some point, to Matt's point, you're going to migrate it to a different tool like a OneHub that watermarks those documents, right? So from a competitive standpoint, and it's definitely something folks like us help you do, because we want to read those documents before we give them to your potential buyer. Right, we want to be like, oh, you're missing a contract from such and such, and because there should be no surprises in that exercise. But to Matt's point, just start getting them in there. But PIIA agreements, for example, if you should have a form PIIA agreement from your attorney, which is an assignment agreement from your employees. Everybody who's ever touched the code should have a release associated with that. Every customer contract, every lease, every obligation. So including the founders' assignment agreements need to be in there. So we'll end up reviewing them with you as we sort through them and put them into the due diligence room in the data room. The buyer is going to send you a checklist of stuff they want. That checklist is usually a Frankenstein's monster list of stuff they put together over time. So sometimes it flows and sometimes it doesn't, and sometimes it's redundant asks. And there's a bunch of it that's not really relevant for you depending on the stage of the company, right? Some of it will be like that we don't have any of those, right? In which case you're just going to say, you're just going to hit a checkbox next to it and list it as not actually important at this point. So that's the only other editorial I'd give you on it.
Thanks, Dave. And we did there. In fact, I was just rereading a story about a founder who built a company, moments before their IPO, which was their exit. One of their original co-founders came back and said, you never treated me right according to the signed deal. And they ended up, the underwriters forced him to escrow a third of his shares to cover potential exposure. So it is very serious. And they almost fired him over it, but he was so charismatic, they chose not to. Later on, they wish they had, but that's the whole nother story that you can get into. But just keep track of it. It's fairly easy to do if you just naturally throw it in there, and then, as Dave said, hone it, formalize it, harden it as you move on. But just to start with, get it in there. So on taxes, at a real simple level, you've got, if you're a US company, which you all are, presumably you're all C Corps, although you might be LLCs. And we're not going to get into that nuance because normally by the time an exit occurs, technology oriented companies are C Corps. But just make sure you file your tax returns. You might file them late. You might need to extend them. In fact, most everybody needs to extend them to the filing deadline, which is actually 2 weeks from next week. But get them filed and then store those two in your document management tool. But get those things filed. In Washington State, if this is the only place you're working right now, we don't have state income taxes, so you don't need to worry about that. But do file those returns, even if you go buy TurboTax and just, in the early days, you don't need to spend a ton of money, but do get those things filed. There are R&D credits and some pandemic related credits that are not related to R&D that are available too, and work to optimize those. And I use the word optimize rather than maximize because it takes thinking and time and whatnot to really get as much as you can out of them, and everything's a cost benefit. But think about those and talk to your tax advisor. Dave, did you raise your hand? Oh, okay. Talk to your tax advisor about those things and think about how to do that. A big area, hang on, my earpiece doesn't want to behave itself here. A big area that we see cause troubles in exit is as companies naturally move into other states, an employee is in a different state, they start selling in a different state, they open an office in a different state. Not a lot of office opening these days, but certainly all those sorts of things. There's registration requirements and tax filing requirements, sometimes payment requirements too. And you're never going to be perfect at that. And unless if you file in every state, in every county, in every city, but I think very few companies do that. But develop a strategy for it. When we get to a certain size, we're going to do this. Again, work with your tax and legal advisors on that. And then once you decide to file, make sure those things get filed. And sometimes they're monthly, sometimes they're quarterly or annually. Have a calendar in place. Again, as a founder, get accounting help. Our firm doesn't do that kind of monthly filing sorts of things, but one of the other sponsors, now CFO, does, and there's other services group that do that. You might be lucky enough to find a part-time bookkeeper who's one-off to do that for you as well. But just do those things when you're required to, and keep them on file. Consider a tool like TaxJar or Avalara for sales tax. As you start filing in more and more states, they'll be able to pull that data out of your accounting system and file those things fairly easily once you kind of get it set up. But that's really as your revenue starting to scale. Another thing is you're issuing stock options. There's something called a 409A valuation, which is basically a analysis of how much your common stock is worth. And that then sets your stock price, your exercise price on your stock options. Early days, your board will you can just kind of create your number based on your best guess. But as you especially start obtaining financing, you need to be a little more disciplined on that. And these 409A valuations can be very inexpensive to get, but provide a foothold around that tax issue. It's really only your employees that are exposed to that issue, but you're one of your employees often, and certainly your team is, and you don't want them getting hung up by the IRS later in the process. Also, we're seeing a lot of, and I'm going very fast here, so if any, jump in. Matt, my colleague, Matt Sartorius, is over there. He's kind of keeping an eye on the chat. And if anybody has questions, just throw something in or just say stop and wait, and then I'll, or just interrupt me. But that's kind of that piece. And then we see a lot of emerging technology companies, having people outside the U.S. or interests outside the U.S. customers. Sometimes a dev team in, Eastern Europe or Spain or South Asia or other places, and that adds a level of complexity. It's also can be a very good thing, but as you get into that, be aware there are tax issues, of course, in those countries. And also the US becomes more interested when you start having money go back and forth across the US border for potential money laundering issues and whatnot. So there's additional tax reporting. There's not typically additional tax payments, but there's additional reporting. And the only payment comes in if you don't do this reporting correctly, make your best effort to do it correctly. Can be large, tens of thousands of dollars of tax penalties. Even though you didn't owe any taxes, you might owe $100,000 in tax penalties because you didn't file what you were supposed to file when you were supposed to file it. So I've run through, again, a very broad list of stuff. But the bottom line is, I think, have a good attorney who knows this space, have a good accounting advisor who knows this space. You might find somebody who can be a formal advisor to your company with that background, or a firm like now CFO. We work on part of this as well and blend together with the attorneys and the now CFOs of the world to do that. But don't try to figure all this stuff out on your own. It's not worth your time. Get help. Ask Dave. Ask Koki. we're all available. We're happy to jump on a call and have an informal, non-reliable chat, as I emphasize. I hate to say I'm non-reliable, but I say it broadly and quickly, especially when I'm being recorded, that, until you formally engage an advisor to formally do something, it's good information, but, may need to be fine-tuned later. So
One
that's
thing
sort
I'd
of,
add there and double down, Matt, to your point exactly. All of the people on this call are smart enough to figure out QuickBooks and do all those things, but I would say I would recommend you not do it. Like you're getting your chart of accounts right and having it set up correctly by somebody who's now CFO or Denali are good examples of somebody you can come in and pay on a part-time fractional basis to make sure it's set up right. If it's set up right, it's pretty easy to do, right? You can stay in, but I can tell you from personal experience, paying somebody on Fiverr to reconcile a year's worth of bank statements because it was inexpensive is going to be the most expensive, cheap decision you ever did. So just from personal experience.
Yeah, and I do a little bit of, I'm a very little angel investor occasionally, but I'm fully invested now, so that's not why I'm here. But one of the companies I invest in, the CFO or CEO would call, or founder would call every now and then, and ask a couple questions, which was great, and I loved it and all that. And then one day he's into this, how to file this and this with the state or whatever, a county or something, and I'm like, why don't you have your accountant do that? He said, well, they charge $100 some an hour. And I said, look, I'm an investor. I need you out there building a team, building a product, finding customers. Don't do this. Now you're pissing me off, to be blunt. So it's just, there's only so many hours in a day, and just use them wisely, because that's your biggest point of capital at this point. And that Dave kind of transitioned me into financial reporting. Again, very early on, pick an accounting system. Most everybody uses QuickBooks. If there's anybody who's a fan of Xero on the phone, it's a good tool too. Europe tends to use Xero more for some reason. The US tends to use QuickBooks more. But whatever you're comfortable with, just pick one and use it. Do the best you can with it. Like you say, have somebody set it up for you is ideal, or just use the generic setup with a plan to, as soon as we get a little bit of money in the door, we're going to have somebody come in and kind of clean it up early on so that you get the right runway going forward. And then you'll have a bank account, of course, and credit cards. Those can easily tie into that system so that stuff reconciles regularly. I almost put monthly here, regularly every 3 months. Don't wait a year, like Dave said, because it's, you want to get another part that in an exit people care about is, when you incurred costs, did you, record that in the right month? And those sorts of things. And so that's why those tools are helpful, to get it so that people can start to see trends around payroll expense, marketing expense, depending on where you are, what your social media spend is or whatever. People like to see trends. And when it's this big lumpy mess, not because you spent in a lumpy way, that's not a mess, that's just reality. But if your accounting was messy, it just kind of reflects poorly. Consider accounting tools then, a payroll tool, a bill pay tool, a billing tool that also integrate in with these systems. It starts to add up dollar-wise. Be careful with your dollars, but don't, be too thrifty with them that you're not, that you're wasting your own time. And then again, very early, build a cash management tool, because that's, how much cash do I have and when do I run out of it? Or the, two big key questions. Can be a simple model at first. It'll evolve over time. I have on here too, if you have a board, build a financial summary tool for them. The key here is it can be very simple early. It might just be, this is how much cash we have, and this is how much cash we spent last month, which is a best meter of maybe how much cash we have left. It can be a little more sophisticated than that. Be true to your board, though. It will, if you do any projection, it will always end up being wrong. But just be honest about that. Here's what we projected last meeting. Here's where we are now, and here's what we're projecting for the next meeting. And don't suddenly start changing all the metrics and shifting things around like a hide the P game. Be true to your board. Be honest about what's going on, and they'll be super supportive of you and helpful. If they start feeling like the story is always a great one, even though the results haven't been, on with expectations, but they can't remember the expectations because you seem to be moving things around, it can get messy in a hurry. As revenue begins, pick a, what's our revenue model going to be? Dave's blog has an excellent, how many revenue models do you have? Not 16 or 17? Whoop.
Sorry, I was on mute. 14.
14.
Yeah, the 14,
okay.
14 used in tech.
Yeah. And so, SaaS is a common one, but might be a license model. You might be selling product, yada, yada. You might have more than one, and so start really thinking about that in terms of how does that revenue grow, develop unit costing, how much does each unit of revenue cost? It's a little weird in SaaS because it's kind of, there's not a lot of incremental costs, but there are some certainly to go get the new customer. And then just continue to develop your revenue and cash flow model as you evolve a little bit farther, and as cash flows, as revenue scales and you start getting more and more, you'll want to start formalizing accounting policies. Don't worry about this too much early on. And the real reason, probably where most of you are now, you don't need to have a formal accounting policy for things like this, but be aware that that is down the road. And I think a key part, similar to, use advisors for things to save you time. Also, don't try to bite off, fully what we call GAAP, generally accepted accounting principles, the full, like public company reporting. You don't need to do that as a private company. You shouldn't do that as a private company. It's way too expensive. But evolve into it as your business scales. And so that's kind of what I'll be getting to here as I move into the next page. But let me take a breath here and ask if there's any questions or anybody want me to talk more about anything or stop talking or anything. Okay, and Dave, how much time do I have left? Or have I run out?
You got a couple more minutes.
Okay,
we'll transition. I want to make sure we have time at the end for everybody for Q&A more broadly too, so you're good.
All I'm going to say here, this is a long list of becoming fully GAAP compliant. You won't be and may never be. But if somebody says, are your financial statements GAAP compliant, pull this out. And if you've done all these things, then they are. And if you haven't, they aren't. And don't let a buyer force you into telling them we're going to give you GAAP financial statements if you haven't at least thought through this stuff. Now we can, be engaged, or any CPA firm can be engaged and help you think through this. But I have seen a lot of companies in an exit by a big public company sign something saying we warrant or we represent that everything's fully GAAP compliant, and then they get hammered in closing with all this stuff. I won't use a more flavorful term than that. So just be aware of that. And that's why I list out all this long stuff, is these are all great things to do if you ever want to get there. Sometimes you may not need to get there, but way too many founders have been sucker punched by a buyer who will come back to them even afterwards. And I've seen founders fired who go into companies and acqui-hire mostly because it wasn't working out, but they point to, well, you didn't follow GAAP for blah, 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 whatever. So we're firing you because you violated this rep or warranty. So just be aware.
Yeah.
Don't
making sure you understand the reps and warranties, because before closing, you're going to have a whole bunch of reps and warranties that we're either going to say we're going to waive off and not accept, or we're going to accept. So to Matt's point, you need to know what they are and not guess. And your attorney will help you with that. The advisor will help you with it. But to Matt's point, there's big companies make big asks when they acquire you, and some of them you need to say no to. So, but there's some of these things you can't say no to, right? So know that the gap compliant one is you can say, we're not going to give that in our reps and warranties. So.
Yeah, no, and we've been down that road with a few, and they will be flexible, but you kind of need to cajole them into it. And when their accounting group gets in, there's the deal guys, deal people, and the accounting people. Work with the deal people on this, because the accounting people are people like me that will drill you down on all these and want everything. And the deal people are more like, we want to buy you, and so we'll talk them into waiving some of this.
It's a
stuff.
business issue versus a technical issue for sure.
That's right. That's right.
Awesome. So let's.
Yeah.
I want to transition to the Morgan Stanley team here, and then I'm going to come back in for some Q&A at the end for everybody. But Seth, I know you're in the airport lounge, so you're going to hand it to Matt. Who's going to take point?
Yeah, I'll do the
You're going to do color commentary. All right, Matt, go for it.
For
With
sure.
Matt
So,
today.
there was something that both Matt and Dave said on a couple of occasions, which was having the right team. And it's interesting. On the wealth management side, there's so much that we'll walk through that we can help with, but early on, we believe that is the most important thing. And I know a lot of times people in the kind of founder space are like, yeah, but that costs money, and there's this and there's that. Really from our desk, there's very little money in it for us up front, right? So if you hire Clark Newber, they're going to say, hey, we're going to do this for you, here's your bill. You hire Denali, they're going to say, we're going to do this for you, here's your bill. With us, a lot of it's paying it forward. So one of the things that we've talked about, it's almost like if you are pitching somebody to raise funds, it's a similar idea, right? You have to have somebody believe in what you're doing and what you're trying to accomplish to want to pay it forward and really help see this through, because it's more so in the later stages where it becomes fruitful for the wealth management world to really be helpful to you. But there's so much that we know early on. So what we wanted to do is go through kind of a few questions. And I think the first question really is all about who's your team. And I want to share my screen here, and I'm going to burn through this kind of quickly. But as we think back, so many people hear Morgan Stanley or Merrill Lynch or UBS or whatever it is, and they automatically think like stockbroker, right? And if we go back to our roots 20, 30 years ago, that was the case, right? We started off as stockbrokers, and it was all about investments and which stock you should buy, which stock you should sell. But that is so far removed from where we are now. And really what you want to look at is moving up this hierarchy. There was then investment managers where it's like, I know a guy, and then there was wealth managers where it's like, now we're starting to get much more comprehensive. But really what you want to look for is this idea of an integrated team, right? And one of the things that Dave and Matt mentioned before is that a lot of the folks that you're talking to early on aren't actually there to help you, right? They're there to help the company and help the company succeed. So when we think about what this looks like, sorry, it's super weird when you roll the mouse the way you think it would go, it goes the opposite way. So I keep going back and forth. If we think about what this looks like, and if you're, setting out to try and find the right partnership early on, these are the things that we would think about and encourage you to think about. So having this integrated experience, you want people that are going to be able to help you and operate with precision. You want people that are going to have access to all these different groups of people that you need to connect with. And you also want to make sure that there's somebody that's going to help with implementation. And so if we kind of take these one by one, starting at the top, we think about the human element. And that's a huge piece of it, right? It's not just, oh, here's somebody with this company that may go public or may be acquired, right? Whatever it is, it's let's really understand, who are you? What are you looking to accomplish? And how can we help you with that? And so often it comes down to building trust over time. And it's really this big shift from, I've got a whole bunch of watches to sell you, to what are the solutions, right? We want to help find solutions, not, sell products, which is what used to happen in the past. The next piece is having this idea of a cohesive team, right? Going from, I know a guy, to this is the group that we've worked with. right? For example, working with the folks at Clark Newbert to integrate some of the business side of things with your personal side, and having this group that is actually engaging with each other so that you have the right hand talking to the left, because otherwise it's like a game of telephone. So many things get lost in translation. And the last piece that we think about is really having a systematic process to help you walk through all of this, because I don't know if it's this way in other professions as well, but there are a lot of advisors in our space that don't really have a process, right? It's kind of like, well, this is what I feel today, let's do this. But you want to go from having this arbitrary setup to a methodical process that you're working through to identify opportunities, know when things aren't going right, and figure out how to course correct, and always be working to stay ahead of the curve. And so when we think about this team that we talk about, we think you want to look for this because, at the end of the day, the clients that we're working with, we want to be everything to them, right? We want to be everything to them. And the reason we want to do that is so that they can be everything to the company and all the people that are counting on them, right? Whether it's their family, their employees, their investors. And that goes back to what Matt said. We want you to be focusing on what you need to focus on. Let us focus on this, right? Let us take this off your desk. And, it's a little different, we feel like, from our perspective early on, because we do have a checklist, but so much of it is so much more situational, right? As opposed to you need this, you need this, you need this, you need this. But, what we really want to focus on next is, as we're working through all of these things, the big piece of it is surrounding taxes, right? That's the reason why so many things from a planning standpoint are implemented as you and your company become more and more successful, right? So I want to start just with kind of a high level overview of the different types of taxes, because otherwise I'm sure a lot of people are sitting around like, why would I give my money away? Right? Like, why would I want to do all this complicated stuff? Why would I pay all these attorneys and all these accountants and all these advisors to do all this stuff? So if we think about, there's a couple different kinds of taxes that we're referring to in this space. The first is estate taxes, right? There's federal estate taxes. There are Washington state estate taxes. Currently, the federal exemption is, let's call it $12 million a person, $24 million for a married couple. So what this means is you have, if you were to pass away today, you and your spouse, you would have $24 million that you can pass on to your family without having to pay any estate taxes. Anything over that then becomes subject to federal estate taxes. And I know what a lot of people may be thinking at this very moment. It's like, well, that's a lot of money. Like $24 million is a lot of money. Like, that'd be an awesome problem to have, but I might not have that problem. But what we really got to think about is a couple things. One, the rates are very likely to, or the exemptions are likely to come down at the start of 2026, right? If nothing happens with the government, that's set to happen. So it's going to go from 24 million down to 12 million, right? So that's a big piece. But the second piece is there's also Washington state estate tax, which a lot of people don't know about. And I'm gonna round, you get an exclusion of about $2.5 million a person, which is $5-ish million for a married couple. And all of a sudden that becomes a lot more real, right? You live in Seattle, you might have a 401k, you got some life insurance, you got equity in your house, you had some options that you got somewhere. This can add up really quickly from that standpoint. And so the idea is, are there ways that we can do planning now so that we can take advantage of what's available so that you aren't crossing these thresholds unnecessarily, right? Like, hopefully you're crossing these thresholds. I hope everyone on here has to pay estate taxes, because that means they made a lot of money, right? Or had a lot of money when they passed. But when we think about all of this, it's like, if you imagine yourself 10 years from now, right? You're sitting on the beach or in the mountains at the ski lodge or wherever you like spending your time, on the golf course, you're like, gosh, I have so much money. Like, I realistically am never going to need this. Everything works so well. The company took off. It did fantastically. Everybody's happy. I got my exit. Now here I am. What should I do? And I start thinking about like, all right, well, it'd be cool to give my kids some money. We can do some stuff for charity. Maybe you're charitably inclined, maybe not. But what we start to find is that if you're thinking about it 10 years from now after it happened, you passed up a boatload of opportunities, right? So what we want to think about is there's this kind of crossover point that's the sweet spot that we want to target. So as your company is gaining valuation, you're in a situation, if you have stock options, that becomes relevant. If you're looking to do gifting, that becomes relevant. Because what you want to do is you want to figure out, at what point do I feel like I am very likely to have success in this company? And so you can start shifting things out of your estate so that you get to a point, once you get that exit, you've taken advantage of all of those lower valuations. So what do we mean by that? So let's take an example. You have a company that you're working on now, and let's say the valuation starting off is $1 a share, just using round numbers again. You fast forward and you're still private, you now have valuations of $10 a share. If you look to start exercising options, that can start to be very advantageous. But here's where I said there's like this sweet spot. If you buy the options and the company goes out of business, that money's gone. If you wait to have a higher probability of success that the company's going to make it, you're going to likely have to pay more in the way of alternative minimum tax, which is something that was put in place for, I think it was the top 100 wealthiest families when it was put in place. So like that would be the equivalent of Elon Musk and Jeff Bezos and Bill Gates today. And now it impacts millions of people because they haven't ever adjusted it for inflation. And so if you're exercising options, you can be in a situation where now all of a sudden you have to pay taxes, but you haven't even sold anything yet. And so that can be a tricky spot. Let's say you hold on and then the company goes public and the valuation jumps considerably. What you're going to be faced with now is an even bigger potential AMT exposure, making it, even bigger nut to swallow and figure out how to do that, get that all in place. So that's one example. Another would be gifting, right? So if you're sitting on the beach or the mountain or the golf course, you're like, gosh, really my main objective, I'm big on my family. I want a lot of this to go to them. There are so many structures where you can start to shift ownership of the company into their names through shares at lower valuations. So then when you get the explosion of growth, it's not part of your estate. So let's say 10 years from now, the amount's $5 million, right? That you give to your kids. If you give them to it now, and right now it's only worth $100,000, you're in this situation where you're only using $100,000 and then it grows to $5 million. Whereas if you wait and it's $5 million, now you're using $5 million of the exemption, right? So these are a couple examples of the power of using different planning techniques at different stages along the way. Because if you do get those big exits, which we're all hoping for, then you're in a situation where you're going to not be able to transfer as much to the people that you care about without being in that situation, right? So now we think about all of that. Another question is like, all right, when should I really do a deep dive personally on my situation, which I know is probably hard because everybody's running and gunning. It's like, oh my gosh, I don't have time to take care of myself and my own picture, right? I'm taking care of the company and all my employees. And so we really think that anytime there's a big event with your company, so if you're raising more funding, if there's acquisition talks, any of these types of things, you want to do that analysis to look and say, is now a time where I should be working to exercise options because I'm in a situation where I can do so at a lower valuation. And if this round is raised, then all of a sudden we're going to have to pay more tax potentially to exercise the same options. Is now a time to do gifting, right? And there's all sorts of strategies, right? And again, we can get into the nitty gritty details, but I think that that's almost like saying, you know, we're in elementary school, and when you get ready to submit your college applications, you're going to do this, right? Like, it's still a ways out there. I'm guessing most people on the call will not be thinking of this in 5-10 years, based on this call alone. But one thing that is also super important, right? We're in this situation often, we're working with our clients, markets are down, investments are down, and they call up and they're like, oh my gosh, what are we going to do? Right? Like, it's down, this is horrible. And we say, well, you've got, you know, a bunch of cash sitting over here. You can actually buy into the markets at a much lower price, right? So we're looking for what is the opportunity to be had. And a lot of times when we think about down rounds, it's kind of that same feeling, like, oh, it's just crushing, right? Nobody wants this down round. If you do run into one of those, similar to buying into markets at a lower level, that may create opportunities for exercising options with less potential taxes. That may create opportunities for gifting at lower valuations. And so it's always being mindful of this and working with the team, because just like Dave said earlier, he said, look, we're going to look at all your documents before you ever give them to anybody, right? So if you have the right team in place, they're going to each step along the way say, hey, we got to be looking at this. We got to be thinking about this. What about this? Have you done this yet? Have you not done this yet? Right? Kind of a deal.
So, Matt, I'm going to get super tactical in the questions, because I know that for us as founders, it's usually like 150% of my assets are tied up in the assets of the company, and right now it's not liquid. So why would the Morgan Stanley guys even want to talk to me? I'm using guys generically because he's on the call. But so a couple of observations there. One is how early should I do planning? The answer is probably now, at least to know from a because you all will help with like, hey, where do I want to go, right? And it's weird for us as founders, because we're like, you know, all of my asset is here, all of my debt is here. I've mortgaged my house to get here. Like, it's kind of, for me, the first time I was like, oh my God, this is kind of embarrassing to actually I've got like financial trauma in my background by comparison, right? Because you've done everything you had done to get here as an asset class. So, but it actually becomes one that you guys can actually help say, here's how you should think about it. There's no cost, right? To your point, you're paying it forward at this point. And things like, I think of some practical things like changes in tax codes and stuff that we as founders are never looking at. But things like a 1202 exemption, or how, you know, that, are we an LLC or a C Corp, and is the timing, like one of the questions we always ask is like, how long have you been a C Corp, right? Because if you've been a C Corp for 4 years or 4.5 years, the answer is you're going to drag your feet before you actually sell, because you want to hit that 5-year mark because of the tax advantage. So take a minute and talk about 1202 and why, if you're not a C Corp, we probably want to get you migrated over. Well, your attorneys will want to get you migrated over.
Yeah, definitely. And, you know, one of the things Matt mentioned earlier on is that, you know, most people are a C Corp that they're working with in this situation. And I think the reason being for that is you're in a situation where you get all sorts of preferential tax benefits on the back end, right? So if you're in a situation where, one second here, I'm just flipping through, you're a C Corp. Dave just mentioned that. How long have you been a C Corp? If you've been a C Corp and held these shares for 5 years, and you got the shares when the company had assets that were less than $50 million, you get to this spot where when you eventually sell, you can get up on the first $10 million of gain, 50 to 100% of that's not subject to tax. And that's huge. Now, here's where it gets, I'm going to say huger. I know it's not a word, but it just sounds right here. It goes from huge to huger, is that's not just for founders. That's for anybody. So now think about it this way. If we go back to that gifting stuff that we were talking about, you can say, I'm going to have some, I'm going to give my spouse some, I'm going to give each of my kids some. And guess what? They all would qualify if you qualify, right, in this scenario. And that works for your key executives, for everybody. So this can be a huge thing. And it was basically an incentive that was put in place by the government to get people interested in starting businesses. And when you start looking at the tax savings on that, it's huge. It's absolutely huge. And it's funny, Seth and I were working with somebody at one point and he was at DocuSign, and we're talking to him, I don't know, a couple years ago, and he's like, yeah, my stock's all QSBS, qualified small business stock, because he had gotten in early enough at DocuSign that it qualified. So he had this huge exemption on all of his capital gains, which I'm sure if any of you have worked at one of the big tech companies around here and had to sell stock at a gain, it's painful, right? And so if you can avoid that, especially if the company has huge success, that is a tremendous benefit, right? So that's where early on, the question becomes, are you a cash flow business, or are you looking to have an exit? And I'm guessing most of the people in this scenario are looking to have the exit, right? And so that's where, again, I'm going to say the same thing Matt said. I'm not an attorney, I'm not an accountant, but that's where being a C Corp could really come into your favor down the line.
Hey, Matt, can I ask you a quick question? This is Avi.
Go for it.
So is this QSBS also applicable for options, or is it always RSUs?
Do you know the answer to that, Jack?
My inkling.
Not RSUs is the answer. Sorry.
Yeah,
Go
no,
ahead, Jack.
it's shares that you have received directly from the company, right?
Yeah, so it has to be restricted stock units and not options, because options are just an option to buy.
Well, options, if you exercise the option and then hold it for that time period, then you own the stock, but you have to exercise the option. So, and again, released in some, live through the pain, but not a tax accountant, right? So the answer to the question would be, if you exercise them and hold them for 5 years, you're in a QSBS. If you exercise them at the time of the sale, you're in regular income.
Yeah. Okay. Got it.
Yeah, that
And it's something you need to
understand too.
Yeah, it's something you need to help your employees understand too, because at some point, employee stock options are always something you have to educate the team on anyway, right? For them to actually have value or perceive value, that versus like a lot of us have probably had stock options from the past, and the answer was, I didn't know. Like, kind of hope there were something, right? And but so definitely requires some education. So,
yep.
Go ahead. I'm going to actually open up for questions. So this is perfect timing. Go for it.
Sonia here. Isn't there a deadline to file QSBS? Like, aren't you given like some amount of time frame or something like that? I remember
an 83B election has a deadline. But so when you first incorporate, you have a window to do an 83B election. So that's on the window, and your lawyer will make sure if you haven't done that, it is probably expired. But you have a short window on that. A QSBS just has to do with when you incorporated. So there's nothing, if you're incorporated as a C Corp, whether it's Delaware or Washington or whatever. So again, I feel like, to your point, Matt, about being recorded, I'm not a lawyer and don't play one on TV, but I've spent a lot of money on them. So I definitely have opinions about stuff. So I call it Dave's opinion.
I think to answer the question, because I did the RSUs thing, you have to have done the 83B. If you don't do the 83B, then you're not eligible for QSBS, even though the company is actually QSBS.
Yep. Because in essence, what you're doing is an 83B is basically telling the IRS, I'm exercising them now, and that starts my tax basis. So that's the exercise point. So Medlin's nodding his head.
That's why I'm not a tax expert either, but that's what I've been told. And I actually have some that are just hit that with a company I advise. So I'm hoping that's right too.
Other questions? I know we've covered a lot of ground today in the mix of both personal and business, but the goal was to give you an overview of it. So go for it.
Yeah. Hey, this is Ryan. Hey, thanks for everything, guys. Quick question. All the advice, and especially the checklist, and it seems it pertains to a general exit, but there's different flavors of exits, right? So I'm curious is that, is there an inflection point where things drastically change? Like, for example, I've learned going through this right now, an exit could be a company can actually purchase the shares I have, or they can actually do an asset purchase agreement. Or depending on the size of the exit, are there any inflection points where things drastically change?
Yeah, so we think about this first is, right, and then what's the waterfall? So which is really comes down to the preference stack. So whether it's an asset purchase or a stock purchase, right? So one case they're acquiring the company, the assets and the liabilities. In many cases, they're just acquiring the assets, and the company just basically winds down. So there's no claim for any hidden liability to make against the company in the future. So those are really the two mechanics. But in both cases, you have cash coming in. I'll talk about acqui-hire in a minute, but in both cases, you have cash coming in, and then the question of how does the cash gets paid out? And unless there's something strange going on, which happens on occasion, there's what's called a liquidation preference and a waterfall. So your attorney's going to opine on that, right? There's tools that like Morgan Stanley and other folks have that allow you to do some modeling, but ultimately your attorney's going to opine on it, because if they're wrong, right, the attorney's going to have insurance that backs them up, right? So we can do the draft. You and I can do a draft version of it and go like, yeah, it feels like this. So for example, the B shares get paid before the A shares get before seed, and seed get paid before common. It could be that they all convert at the end to the same if you're going public, or it could be that some of them have liquidation preferences. So they get a 2x or they get a participating preferred versus just a preferred. So terms that at the time when you're taking money, you kind of take it and you're like, yeah, it seems fine. And then most people never look at it again until they go to exit. And you're like, oh, wait, these guys get 2x their money back, and then they get to participate on a pro rata basis. So that's called liquidation preferences. So we had one deal last year that I would tell you we got an offer that didn't get to a high enough price point. It was good for the investors to exit, but it wasn't good for the founders to exit. Like they needed to be at least $3 or $4 million above, because the liquidation preferences basically put the founders in a spot where they're like, why would we sell it for that? Right? Because it's, even though it's good for the shareholders, it's not necessarily good for the founders. So liq preface, what you'll hear is the term, the attorneys will opine on it. And again, whether it's an asset purchase or a stock purchase, it really dictates how the payout is done. So does that help?
It does. Thank you.
And that is, oh, go ahead.
As you say, when we think about an asset versus a stock purchase as well, you know, when a company comes in and buy the assets, right, they're just buying the crown jewels of the company, not the actual stock. And that's where all the QSPS is really ratified. So you have to actually sell your company stock in order to get all of those exemptions, which we spent a fair amount of time talking about, not just the assets and then wind down the company.
Mm-hmm. And one further thing, and I won't pile on too much, but if you sell the assets at a gain, the corporate entity has to pay tax on that,
Mm-hmm.
Which so make sure you have the cash to do that too.
Yep. Thank you.
I would say that the thing I think about when listening to all this is where having an integrated team comes in, right? So that you aren't trying to make these decisions in a vacuum, but you're like, hey, let's get everybody around the table. Let's talk about what's in it for me. Does it make sense, Dave, to your point, for me to do this deal, although it's, you know, advantageous for the shareholders? And then we can come in and stress test, like, do you have enough money to do what you want to do? And does that make sense for you personally? And you start thinking about all the QSBS, right? These are the kinds of discussions that get super interesting. And we can really start to add a lot of value as a group over time.
And hopefully this is a primer for you all to think about it. We'll pass along the checklist from Matt and contact info. So if there's anything that we can answer for you, I know we're at end of time. So if there's anything we can answer for you, definitely reach out separately and we'll follow up with.
I put my checklist labeled unreliable in the chat. So
perfect.
Cool. Do you want me to bring this up quickly, Dave, in case anybody wants to do like a screen clipping, and then I can send it over to you as well. But this is kind of the more traditional. Are you seeing that screen, Jack?
Yep.
Yeah. So if you guys, this is kind of the more nuts and bolts for the different stages of things that we would want to be orchestrating. Feel free to take a shot of that too.
Great. And we'll forward it out as well. All right. Thanks, everybody. Have a great day.
Thanks, Dave. Okay. Thanks everybody. Bye.
Yep. Bye now.